And now let's get some more analysis, and let me bring in my guest, Mr. Chen Jiahe. He's the Chief Investment Officer at Novum Archi Technologies. Welcome to China 24, Mr. Chen. So how will the delisting of the three Chinese companies by the New York Stock Exchange impact the industry development and perhaps international market order?
Good evening. This action will mean very little thanks to these three giant telecommunications companies. If we read the financial statements of these three companies, almost 100% of their income comes from China. This means that they have very little relying on the international market. Don't even mention the listing of their stocks on the international capital market, such as New York. Meanwhile, if we compare the trading value of these companies' stocks in Hong Kong, Shanghai, and New York, you can find that New York market is having a very small trading value for these firms. So that means losing the listing position in New York actually means very little to them. However, the delisting did bring a very good buying opportunity for their stocks in Hong Kong. Recently, some US investors have been forced to sell their holdings for these companies, which are very good companies actually. With their selling, there appeared a very good valuation for these firms. You can see the PE ratio of these companies trading at their lowest historical level. Say 7 times PE ratio, 8% dividend yield. Many seasoned investors, especially value investors and long-term investors, are actually using this chance to bottom fish the stocks of these three firms.
Yeah. All right. Thank you so much, Mr. Chen, for that analysis. And let's take a look at some positive change on the Chinese stock market. China stocks kicked off 2021 with a strong start on Monday. The benchmark Shanghai Composite Index closed at above 3,500 points, a 3-year high. And the Shenzhen Composite Index closed nearly 0.25% higher. The combined turnover of stocks covered by the two indices expanded to over 1.1 trillion yuan. That's about 180 billion US dollars. Stocks related to pork, liquor production, and military defense led the gains. And shares in banks, eye care, and insurance were among the biggest losers. The Chinex index, tracking China's NASDAQ-style Board of Growth Enterprises, gained over 3.7%. And now let's get back to Mr. Chen Jiahe for some more analysis on China's stock market. Well, of course, a very good start for Chinese investors here. So let's talk about this, Jiahe. How do you interpret this latest change, and do you expect it to continue in the short run?
Well, the short run is always very hard to predict, but recently we have saw pretty good market performance across the global market. So the Chinese market seems like in the same pace with markets such as Europe and the United States. Today we have saw a very large dividing between indices and industries. For example, Shanghai 50 stock index held even today, merely rose by 0.1%, but Chinex 50 index rose by almost 4%. And meanwhile, the PE ratio of these two indices are 14 and 74 respectively. So you can see this is a very divided market. That blue chip companies are clearly lagging behind. Meanwhile, the new energy industry has been rising a lot today. Many companies hit their upward limit, so that is also very attractive in today's market.
All right. Thank you for analysis, Mr. Chen Jiahe. Always great to talk to you.